Economic growth means a country is producing more goods and services than before, leading to more jobs and higher incomes. For years, China's rapid growth lifted millions out of poverty and made it a global economic powerhouse. Today, China is deeply connected to the world. What happens in its economy affects everyone. But as we enter 2026, China's era of breakneck growth is over. The economy is slowing, not shrinking, but growing much more slowly. This slowdown brings new challenges for China's leaders and uncertainty for the world. Companies that sell to China may see lower sales, and countries relying on Chinese manufacturing could face disruptions. We'll explore why China's growth is slowing, the problems it faces both inside and outside its borders, and what the government is doing to respond. This includes government spending, interest rate changes, and the unusual situation of low inflation. Understanding these issues is crucial for seeing the full picture of the world's second-largest economy. China's economic engine powers global trade. When it slows, everyone feels it. It can affect the price of your phone, your car, your job, and your savings. By understanding China's challenges in 2026, we can better prepare for the future. The story of China's economy is a global story, impacting us all. As China's growth slows, the ripple effects reach every corner of the world. The choices China makes now will shape the global economy for years to come. Whether you're a consumer, worker, or investor, China's economic health matters to you. Let's dive into the reasons behind this slowdown and what it means for the world. The next chapters of China's economic story are being written right now. In 2025, China's economy surprised many by hitting its 5% growth target. Strong exports drove this success, with factories busy supplying goods worldwide. Despite U.S. tariffs, Chinese companies found new customers in Asia, Europe, and beyond. Diversifying trade partners helped offset weaker sales to the U.S. The government also stepped in with policies to support spending and investment, acting as a safety net. This combination of strong exports, smart trade moves, and government support showed China's resilience. But this growth masked deeper issues. China's economy relied heavily on selling to other countries. If global demand drops, China's growth is at risk. Underlying problems like weak household spending and a troubled property market remained unresolved. The success of 2025 was built on shaky ground, with bigger challenges looming. As we move into 2026, these hidden issues are coming to the surface. The question now: can China adapt before these risks become crises? The next phase will test the strength of China's economic model. The world is watching closely. In 2026, China's economic outlook is shifting. Growth is expected to slow to 4.5%, down from nearly 5% in 2025. This isn't a crash, but a clear sign that deeper challenges are taking hold. The slowdown began late last year and is expected to continue. While 4.5% growth is high by global standards, it's a big change for China. The government now faces pressure to support jobs and stability. Experts predict this slower pace will last through 2027 and beyond. China is entering a new normal of moderate growth, driven by long-term structural problems. The world can no longer count on China's rapid expansion to drive global growth. International companies and policymakers must adjust their expectations. China's leaders must manage this transition carefully to avoid job losses and instability. The world is watching how China handles this turning point. The stakes are high for both China and the global economy. The next steps will define China's economic future. In 2025, China's record $1.2 trillion trade surplus highlighted its export strength. But heavy reliance on exports is risky. China's fortunes depend on global demand. Rising trade protectionism and unpredictable U.S. policies threaten China's access to foreign markets. New tariffs or trade barriers could directly hurt Chinese manufacturers. China's economy is built more on making things for others than for its own people. This model worked for years, but global politics and economic instability make it less reliable. Relying on exports is like building on a shaky foundation. China's leaders know they can't count on exports forever. The focus is shifting inward, encouraging more domestic spending. The export engine is losing steam, and the risks are growing. The challenge: build a stronger, more self-reliant economy. The world is watching to see if China can make this shift. China's biggest internal challenge is weak domestic spending. Household consumption is just 40% of the economy, far below the global average. The property sector, once a growth engine, is now in crisis. Developers are drowning in debt, unfinished projects are common, and home values are falling. This erodes household wealth and confidence, making people less likely to spend. Many families' savings are tied up in real estate, so falling prices make them cautious. Weak consumer confidence and a troubled property market create a vicious cycle. Less spending slows the economy, which makes people even more hesitant to buy. The property slump also hurts industries like construction and manufacturing. These are deep, structural problems, not easy to fix. Boosting domestic demand is now the top priority for policymakers. Without stronger household spending, China's growth will remain fragile. The path forward requires rebuilding confidence and breaking the cycle. China's leaders are responding with proactive fiscal policy, more government spending to stimulate growth. This includes investing in infrastructure and renewable energy to create jobs and demand. Government spending puts money in people's pockets, fueling a ripple effect across the economy. Cutting taxes for businesses and individuals is also on the table. But there's debate. Should the focus be on more construction or on directly supporting households? Some experts argue for cash handouts or vouchers to boost consumer spending. The goal is to shift the economy from investment-driven to consumption-driven growth. China aims to raise household consumption from 40% to 45% of GDP by 2030. Direct support for families could help jumpstart this transition. Fiscal policy is key to rebalancing China's economy for the future. The challenge is making every yuan count. Alongside government spending, China's central bank, the PBOC, is ready to cut interest rates. Lower rates make borrowing cheaper, encouraging businesses to invest and consumers to spend. The PBOC is expected to cut its main policy rate soon, signaling strong support for growth. Cheaper loans could help revive the struggling property market and boost business investment. The central bank can also cut the reserve requirement ratio, letting banks lend more. These moves increase the money supply and make credit more available. Monetary policy and fiscal policy are working together to support the economy. But low rates alone can't fix everything. Confidence is crucial. If people are too worried, they won't borrow or spend, no matter how cheap money is. The central bank's actions are important, but not a magic fix. One unusual feature of China's economy is the lack of inflation. In 2025, consumer prices were flat, evidence of weak demand and deflationary pressure. Low or falling prices hurt business profits and discourage investment. For consumers, falling prices can lead to delayed purchases, weakening demand further. Inflation is expected to stay very low in 2026 and 2027. This shows just how serious the problem of weak domestic demand is. Policymakers must not only boost growth, but also fight deflation. The goal is to generate enough activity to get prices rising at a healthy pace. If they fail, China risks getting stuck in a low-growth, low-price trap. The inflation rate will be a key signal of whether stimulus measures are working. The world is watching for signs of recovery. China's slowdown in 2026 marks a turning point for the global economy. Slower growth is driven by both external risks and deep internal challenges. The government is using every tool, spending, rate cuts, and reforms, to manage the transition. The ultimate goal shift from export-led growth to a more sustainable, consumer-driven model. This transition is difficult, and success isn't guaranteed. The outcome will affect global trade, prices, and financial markets everywhere. Whether you're a business owner, worker, or consumer, China's economy touches your life. The world's second-largest economy is at a crossroads. How China navigates 2026 will shape the future for all of us. The story of China's economy is a story about the world's future.